The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we take a look at the dust settling on Tuesday, plenty of red on the screen, led by the soybean complex. Beans, bean meal moving sharply to the downside. We have a lot of ground to cover. Let's jump right in to talk about it. Welcoming in here to the show today, our good friend Brian Splitt of agmarket.net. Brian, always great to catch up with you, sir. Hope you're doing better than that soybean market was on Tuesday, buddy.
Yeah, Jesse, I'm doing just fine. Thank you for asking. But yeah, it was a pretty rough day all around, wasn't it?
Yeah, it was a rough day. Just looking across the board. I mean, for most of the session, it felt like corn and wheat tried to hang in there, and compared to the soy complex, I guess still kind of did. But it just feels like a lot of bearishness in this market here as we hit the end of February. And let's just start right away with that soybean complex. I know we've seen a bit of a technical washout, technical damage in wheat. We've seen it in corn. Felt like maybe it was time for soybeans here. What's your thoughts with just what you see on the charts there after Tuesday's session? How much damage did we do technically, Brian?
We did a lot of damage, Jesse. And so what I would say is that if you think about corn last week, we broke down out of what I would call an ascending triangle pattern. So we had a lot of highs that were all at the same price, but we had a kind of an uptrend through making those highs. And then when we took out that uptrend, that's considered the breakdown. So the soybean chart has the same pattern, except we just took out that uptrend today. So if you think about what corn is still doing, I mean, geez, this is a week into this sell-off. And, we were down another 12 cents today. So I don't think this is it for soybeans. The measurement for me measures down to about 14.30 on the May contract. So that suggests we still could see, another 50 cents. And that's just to meet the 100% objective of the measurement. Relatively speaking, that 100% measurement for May corn was at about 636 3/4, simply a retest of the December lows. And we took that out and closed below it today. The 150% measurement would be 618. So just because the measured objective is hit doesn't mean that's where it stops and turns around.
I know, obviously, end of the month, we tend to have some different money flow around the end of the month, squaring up books. I know, throw an options expiration there. Plus two, look at the South American crop, Brazil, namely. I have to wonder, did all of these things kind of come together to maybe drive some funds out of these markets, particularly soybeans on Tuesday?
Yeah, I think for the soybeans, there's a rumor that Siner Grain, which is China, is washing out some Argentina purchases in favor of Brazil. Who knows? It may just be, hey, Cargill, Argentina says we don't have the beans, buy them from Cargill, Brazil instead. And but they are able to do that at a cheaper price. Brazil is trading, I think, about $25 a ton under Argentina, and close to $90 a ton under U.S. soybeans. So, these are things that we've been talking about for quite some time, that eventually this big Brazil crop is going to catch up to us. But what that does, though, is that now if that's 1 million tons less that Argentina as a whole, as a country, is going to have to send to China, which means that's 1 million tons that they can keep to crush for meal. So that should help relieve some of the pressure in the world meal market. And so we did have meal break down a little bit today. But yes, the move in soybeans did the most chart damage. November beans back below 1350. It looks like we're probably primed for a retest of those January lows in that 1330 area. If you take that out, I would say you had a 1330 low. We went up and made a high right at about $14. So that's a 70-cent rally. So if we fail through 1330, that should project 70 cents through that, which would take you to about 1260. There's a gap to fill at 1269 and a quarter, and I think that that's a very likely objective to hit in the next 30 to 60 days.
Now, Brian, we've been talking for weeks now. You and I have, your colleagues, I've talked with other folks, just pointing out the downside risk in these markets, corn, soybeans specifically. I'll stick on those for right now. As we look at the down moves we've seen, the chart damage that's been done the last few sessions, I think this has got to come back to a risk management conversation about, okay, if you haven't necessarily made some of the moves you were thinking of making, do you make some of those moves now after seeing some of this technical damage done in quart of beans, Brian?
Yeah, so I mean that's definitely some risk needs to be managed. For us internally, we've recommended being 50% sold on both new crop corn and soybeans, and so we feel pretty good about where we're at there. We've done an awful lot on corn in a short period of time. We're trading a lot like 2013. And that year we did make some lows in the early March timeframe and bounced into the planning intentions and quarterly stocks. So I think part of this sell-off really started in corn with those Ag Outlook Forum numbers, and just the realization that, hey, if acres are 91 million and you throw a trend line yield, and you can argue about their trend line yield all you want, but that really changes the outlook of the balance sheet, and you're close to a 1.9 type carryout number. That's definitely not $6 corn, and frankly, if that's the carryout that we achieve big picture, that's not $5 corn either. So yes, I think you have to look at rallies as selling opportunities, but let's not forget we still have a tight old crop scenario. Likely the USDA will reduce the corn for export on the report next week. We've probably priced in a chunk of that. So maybe after that report, that might be the impetus to go up and bounce a little bit into the end of the quarter and end of the month for that report. But boy, it's just been a tough one here. And if you're still at profitable levels, you really have to think about getting something on the books. And if it does bounce, layering in some more sales.
Yeah, a lot of things to consider. And I know you brought up those Ag Outlook Forum numbers. Were you as surprised with the reaction in the grain markets to some of those numbers, the acreage number, the farm income forecast, et cetera, all the numbers that they threw at us? Because I know typically in the past, the trade usually just kind of looks at those numbers and says, okay, and for the most part kind of moves on. Were you surprised by some of this bearish reaction we've gotten in the market?
Right. I've been told, right, that the market doesn't care about these Ag Outlook Forum numbers, but
Yeah.
geez, I think part of the problem is we just haven't had any news at all.
Yeah.
We've had weeks without a commitment to trade report to tell us where the funds are. And maybe it was just that we finally got some numbers to trade and they were bearish. The funds know they're long, but they don't know how long they are in the big picture. And we're getting towards the end of the month. So I think that maybe just drove the idea that, hey, the balance sheets are going to change without a weather problem. And we're going to book some profits here. And so in a typical year, you probably won't see the same type of reaction that we had this year, but I think it was just the market was starved for information, starved for a story, and it got a story, and it was bearish. And we reacted pretty aggressively to it.
Now, the wheat markets, Brian, especially Chicago, KC wheat here the last couple of weeks, we've really been doing plenty of damage there. That's kind of where it all started. I'm wondering, how are we maybe finding some support, finding a bottom in these markets? I mentioned Tuesday was not a bad day. It wasn't great, but it wasn't bad. Do you feel like we're maybe finding some support? What do the charts tell you there?
Yeah, I mean, we're very close to lower levels here. I tend to focus more on the new crop wheat at this point instead of the old crop. I feel like for most of the producers, the old crop is pretty irrelevant. It's more of a new crop issue for them. And so you look at new crop SRW, the soft red, that's the Chicago variety. We did make some new lows for the move, but we're kind of in this downward trending channel, and we're at the low end of that channel. So hopefully we can catch here. You look at the HRW, that's your hard red wheat. Revisiting this this lower $8 price point. So we're very close to support there. And I just think that with the scope of the move we've had recently, it's, we broke a little over $1 here in a very short period of time. I tend to think the funds have some short wheat paper that's attached to long bean paper. And if we start to see further liquidation in the soybeans, that could in a way support wheat, especially while we're down at the lower end here. But I think you have to be very mindful, and we may have talked about this over the last couple months, Jesse, of this continuous chart for hard red wheat. And we're trading an awful lot like 2008. You look at the highs that we made after the invasion, within a nickel of the highs in '08. And what ended up happening is once we got through $8, and we eventually did, it took us about 2 months to break over another $2. And so I've really just been urging hard red producers to have some kind of a floor at $8, just in case this story in the Black Sea region does not give us more opportunity to bounce further.
We are having a conversation today with Brian Splitt of agmarket.net. Brian, you mentioned a couple things, and this just piqued a question in my head. I'm curious your thoughts here. You just mentioned 2008, how the wheat market kind of trading like 2008. Earlier, you mentioned how core beans kind of a 2012 type mindset right now. If we look back at history, is that something we need to maybe think about, looking back at history and how some of those markets reacted, those time frames, to maybe think about what could possibly happen in front of us here, especially for producers who were around and marketing in those years?
Yeah, I mean, I think you have to kind of use the past and similar setups to at least think of, hey, I mean, it's no secret. You think about 2012. All right, so what happened? You had a drought. We went to $8 plus corn. That we did that last year, right? 10 years later. And what does that do? That hurts demand, right? And so, I've had producers tell me, well, I'm not going to sell new crop corn at $6 when I'm delivering old crop corn at $7. And I say, okay, sir, we've seen this movie before. Think back 10 years ago. You told me the same exact thing. You didn't want to sell D's 13 because you were delivering, your old crop at a higher price. But that's how the market, these inverted markets, fix themselves. So it's not a good excuse to not sell. And again, every year is its own market. So things can change. We could develop a weather scenario that really takes us off track from 2013. But I'm a believer that when you have a roadmap in front of you, until that roadmap puts you in a ditch, I'm going to keep following it. And right now it's following that roadmap pretty nicely.
Good thoughts to consider. Let's segue to the livestock trade. Cattle and hogs, fairly decent day there with the downturn in grains. I'm not surprised. We had a little bit of strength. This cattle market, cattle on feed report last Friday, numbers came in pretty much as expected. Feels like we kind of been in consolidation mode for the most part to start the week. What are your thoughts on this cattle trade, Brian?
Yeah, I don't know. It feels like to me, cattle's getting a little tired. I think about feeders and the fact that old crop corn just broke over 50 cents in less than a week. And, we're down another 12, whatever today. And the feeder market was higher, but not impressively higher. So are we starting to run into some bigger picture resistance levels where it's just hard to pay up for these, at these values? You look at the live cattle market, and April had a measured objective on kind of the opposite pattern for live cattle than what we talked about on corn and soybeans. So corn and soybeans had that ascending triangle. The live cattle also had an ascending triangle, but it broke out to the upside instead of the downside. So the measure objective there would have been 166.10. We've hit that. We've traded a little bit through it. So I think the cash market needs to continue to show strength in order for the futures to want to continue to go higher. But I don't know. I mean, I'm still concerned about the economy, and I just continue to look at the low volatility that the cattle options are priced in, and I think there's really no excuse to not have puts if you're a cattle producer, to just make sure that something stupid doesn't happen and leave the upside open. You're at good levels right now, and you switch over to the lean hogs, and I'm hearing some African swine fever in Europe. This is early in that story, so we need to really keep an eye on that. But that could be something that definitely brings in some more export business over the next few months if that story grows further.
Well, and to your point, exports as well. We saw strong exports here this past week, a little over 51,000. China, the top buyer again on the pork side. China buying beef too. So I think a combo of exports, but then also you mentioned the economy, watching that retail demand. That's going to be very key piece of this puzzle, I think, in this protein sector the next couple of months ahead, as we have that kind of lull right now in between, the end of winter and grilling season, Brian.
Yeah, and from a fund manager perspective, you think about cattle, been strong. The hog market, and we bounced a little bit, but hogs have been pretty weak, relatively speaking, towards cattle. And so, when you look at the amount of credit card debt that's out there in the U.S., when you look at the percentage, at least that's being reported, of households in the U.S. that are living paycheck to paycheck, I think I read it was like 65%. So then you start to wonder about discretionary spending for beef. Does pork become popular again? If we have a story with African swine fever build into something more, does the fund manager say, you know what, let's take some profit on the cattle side. Let's look at the hog side as a cheaper protein source and start to build some link there. So, these are all things that could materialize here over the next couple months.
Brian, before we wrap it up real quick, anything you're watching in the outside markets? I know crude oil on the day Tuesday was up 1% to 2%. Stock market kind of quiet. A lot of inflation data out recently here. Anything you're watching in the outside market trade?
Yeah, so you brought up crude oil. It looks like there's a little bit of a head and shoulder pattern there that could materialize. And if it does, that would take May crude oil down to about $63 a barrel. So again, these head and shoulder patterns are not head and shoulders until you take out the neckline, which we've yet to do. But today's highs went right to kind of some highs that it would match up with symmetrically on the other side of the pattern. So yeah, we're up today, but if we see some selling come in here from this point forward, I think you have to be mindful of a break that could be $10 to $15 in crude oil. And if that came to fruition, what would that mean for grains? So that's also something to watch out for. Dollar's been strong. We made some lows there, and we've come off of those lows pretty aggressively. And if that dollar strength continues, that's just going to be one other thing that's going to be tough for the grains to rally through. So again, that's more of a narrative. You could shoot holes in that narrative too. I mean, we had the dollar trade as high as 115, and here we are at 104. So we're going to be bearish, a dollar rally at this point when we've seen higher values. So the relationships don't always correlate perfectly, but all stuff to be mindful of.
Definitely. Well, Brian, I always appreciate the time and the insight. And I know if folks have questions, they need help navigating this market environment and the volatility, they could reach out to you and the team there at agmarket.net very easily. What's the best way to get a hold of you guys, Brian?
Yeah, our general line is 844-4AG-MARKET, so 844-424-6758. Our website's www.agmarket.net, and you can reach me directly at 815-665-0463.
Well, Brian, appreciate the time as always. Thanks for joining us. I know we'll talk to you again real soon. Take care, and thanks again.
All right. Thanks, Jesse. Appreciate it.
Brian Splitt with agmarket.net. That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.